All right, we got about a minute to go before we get things started. Thanks to those of you who are patiently waiting. 60 more seconds until we get going. We got Fridge Opener answer in the chat. The first non me person in the chat. Welcome. Let's see if we could refresh this so the errors get out of there. There we go. 30 more seconds. All right, there we go. Let's X out of that. Flip back to the main camera. Let me get that notification out of there. Full screen webcam. We good. Camera one, perfect. Welcome back to another weekly live stream. We were off last week. We're back this week after a long holiday weekend. I hope everyone had a great Thanksgiving. But we're gonna jump right back into it. We've had a string of 3 successful weeks in a row, which may have not been the most exciting weeks in the row, but we've taken home, I think, about $7,000 during that stretch. And what I've always liked to say about our strategy is that sometimes boring is good. So hopefully, fingers crossed for some more boring weeks ahead. But it's another week where we've carried a very small portfolio into Monday, and as always, 5 days in the market is a long time. So we want to have a good game plan and strategy for how we can deploy some of the free capital that we've saved up as the week progresses. So without further ado, let's jump into it and get back to the screen share. Throw me in the bottom left. We're back. And let's talk a little bit, just very quickly, about what happened last week. Holiday week, short week, and as you can see out here to the right, we were really only about 50% fully cash secured the entire time. That's a very, very safe place to be. Spoiler alert, looking to next week, we're 26.88% fully cash secured, which is a very small number. A couple things to talk about. Nothing really crazy happened with Affirm. MSOS has been a moneymaker for us. That brought home $300 for us. I realize right now I don't have Thinkorswim open, so I'll do that on the side while I talk here. But SoFi bled a little bit more, and that one's kind of been a little bit of a pain in the ass. What I will say is that we did close that one out on Friday so that it couldn't bleed against us any further. But we've kind of been taking a little bit of an unnecessary hit from that one, right? We lost about 830 from it 2 weeks ago, and then last week we lost 540. So that's a little over a $1,000 loss on SoFi, which is not something that we ever like to have happen. But look, we could strike out a couple times during the week because we've got a lot of base hits that line up to get us to an overall profit. That was really the only bad thing I think that happened to us last week. And other than that, I would say we had a pretty mistake-free week, which we're always super excited about. But with that said, let's talk about, I think I had two trades that I loved last week, and I want to talk about those. They're DraftKings, and then they are UVXY. So let's talk about DraftKings first, and I'm loading up Thinkorswim right now in a different window. Give me 2 seconds, and I will drag it over. And I'm seeing now that futures are down 0.74%, so it's a very good thing that we have a small stack headed into the week. So let me close this out, pull this over here. And we've got our chart. I'm right here. Let's talk about it. So let's pull the DraftKings chart up really quickly and then talk about what happened last week. So if we go to the 5-day chart, we're going to see that there's a very noticeable dip on, I believe it was Tuesday. Excuse me, what was the 21st? The 21st, if I click on my calendar off screen, the 21st was Monday. There was a very, very big dip in DraftKings on Monday. I went from 1506 to 1337. So let's talk quickly about the idea of scaling into these trades and what actually happened before talking about how we got to that end result. So off the bat, the one position that we had was these 14.5 strike puts, which are cash secured. And at max profit, we were going to make $300 off those, just if DraftKings stayed above this 1450 mark, which looked fairly likely based off of where it had traded over the past week. No problem there. Now, skipping ahead quickly to the conclusion, Even though we entered the week with a potential max profit of $300 on DraftKings, we took home a profit of $840 on DraftKings. Now let's talk about how we got there. So we know that going into the week, we have our break-even prices, right? If we look at next week, we have this little break-even tracker. As long as these stocks stay above their break-even prices, we don't need to touch anything, right? Because as long as the stock finishes above the break-even price, we make money. No need to reinvent the wheel and make this thing more complicated than it needs to be. But with that said, DraftKings, those 14.5 strike puts that we sold for 0.3, we had a break-even price of 14.2, which if I take these lines off of the chart, this is going to be pretty easy to outline. 14.2 is our initial break-even price, and this big dip that the big dip that dropped, I think is what I was about to say. But this big dip that DraftKings experienced on Monday morning took us below that break-even price. So what do? Once that break-even price gets breached, we add 10 more contracts. And the contracts that we decided to add were the 13.5 strike puts for 33 cents. And since our original position size was 10 contracts and the second position size was also 10 contracts, that dropped our break-even price dollar for dollar or cent for cent from the premium that we received right here, taking us down to 14.2 minus 0.33, which I believe is 1287. Am I making that up? No, I think that sounds right. 1287. So that, excuse me, 1387. So that took us down here. And again, in the scheme of things, is that a massive dip in our break-even price? No. But if you look at where this thing has traded over the past 10 days, that actually is some decent progress downwards moving from here to here, with the idea that if things did continue to drop, we could move it even further down. And then potentially take those positions into the following week and drop that red line even further down and, run the HT wheel, and that's how we typically run our strategy. But with that said, as you can see back from that 5-minute chart, or the 5-day chart, the 5-minute, 5-day chart, there you go, a little tongue twister. It continued to drop, right? And sometimes these are pretty dangerous, right? It can be like you're catching a little bit of a knife. But when something like this happens, we want to understand, one, why it's happening, and two, if we're comfortable scaling in, or if we think we should just hold on to that initial size. Since we started with a 50% position size, I'm typically comfortable no matter what's going on in upping to that full 100% position size. And the news here was that there was a hack on DraftKings. And at the end of the day, I believe the news came out that the dollar value of the hack was only worth about like $300,000, and that they were going to compensate all of their customers who were affected. So really no harm, no foul there. So with that said, it ran back up and we got where we wanted to be. But as it continued to drop further below that second break-even price that we had, we said, okay, once it dropped below this red line, we wanted to add more and get our break-even here. Once it kept dropping to get below this one, we want to be very careful because we got to like a 150% position size, and that definitely is a little bit of risk. But we wanted to stay patient. And once it got near the 13 level, we said, okay, kind of enough is enough. And why did we say that? If you look at the 20-ish day chart here, actually backing out to the 180, this 13 level is one that historically has been a decent one price-wise, right? So we see if we draw it at, this is at 1260, 1270-ish, but in that area. But we've seen a bounce here. We've seen it bounce off before the big rip back in July. It bounced off there again most recently in mid-October. And yes, after earnings, it did sink below there, but quickly ran back up. But from a short-term perspective, I was pretty happy and comfortable with that 13 level. So on that 5-day, 5-minute chart, when it did get down near 13-ish, we said, okay, we're happy to go into that 150% position size. And we did so by selling 13 strike puts for 41 cents, and the individual break even on those is 12.59, right about where we drew that red line that we looked at a second ago. And when you go above the 100% position size allocation, right, a full position for us was 20 contracts. Adding these 13 strike puts was 30 contracts. The goal is to get in and get out. So once DraftKings rebounded a little bit, as we suspected may happen, before the end of the day on Monday, these 13 strike puts that we sold for 41 cents, we closed out of those for 20 cents. We said, okay, let's get back to a reasonable position size because, look, the biggest lesson in the market is things can always get worse, and we always want to have that in the back of our heads. So just in case, even though things got better at the end of the day, just in case they did get worse at the end of the week, we wanted that buying power back so we could go back into them if it did happen again. But lesson there is we stepped up to 150% position size, which is a little bit risky. But when RSI was looking the way it was, right, it was sharply down into the blue here on the 5-day chart. We get that bounce we want. We open a more conservative strike, and we just take that profit. So heading into the end of the day Monday and beginning of the day on Tuesday, we had exactly what we wanted. We had that 20 contract position size, and we were able to ride that out. So we got $330 of profit on the 13.5 strike that we initially added. We got the 210 that we got from that in and out that we had on Monday off the big dip. And then, of course, we had that 14.5 strike put, which was our initial position heading into the week, and we held on to that. And since DraftKings finished above 14.5, we took home max profit on that. So even though we set out at the beginning of the week to make $300 on DraftKings, this big dip, while at the time was like, oh shit, the stock's moving against us, this was actually a decent opportunity for us, allowing us to scale further in because we were relatively conservative at the beginning of the week with the amount of buying power that we used, but it allowed us to use that cash that we had on the sidelines, scale in patiently, and then pull back out and finish up the week with $840 of profit just off of DraftKings, even though we only set out to make $300 off that. So I think that was one of my two favorite trades that we had last week. The second is going to be UVXY. These were actually debit spreads, right? We talk so much about things in the scope of option selling. This was technically an option buying opportunity. However, I think it derived a lot of its value from the selling portion of the spread. And I'll talk to you a little bit about what I mean by that. So if we take a look at UVXY, those of you who follow us are very familiar with this instrument. It typically looks like this. This is like a leveraged volatility instrument. When the market starts to sink down, you'll see these little spikes every now and then. So a lot of people think about it as a way to potentially hedge the market. But with that said, it was really starting to run off. And yes, it does run off a good amount. That's normal because, typical movement in the market is flat to slightly green. And that causes volatility to run down. But with that said, it was running down pretty hard, right? And we're at the 180-day chart. And we love to look at RSI as a technical indicator, letting us know if something is a little bit overbought or a little bit oversold, meaning it would come back down or go back up respectively, being overbought or oversold. And as we can see right here, if we look historically on the 180-day, we could do that, retroactive look at it and say, okay, the last few times it's gotten this low. The first was back at the end of July. We saw a little bit of a run right back up right there. It happened again mid-August, and it flattened out. And the time before that was about the end of October-ish, where we see a little bit of a spike, and it hung out just below 10 a share for a little bit of time. But with that said, we saw a very similar trend, at the back end of last week. So if we look at this, RSI on a 180-day basis was very, very low, down into the blue right here, and we said, okay. We looked at the 7.5 strike call because I almost wanted to get bullish here, right? The market was running up. Not a lot had happened. I don't know if I really felt that the market deserved to be as high as it was. So I wanted to play this stock bullishly, but the way that I wanted to do it wasn't just by buying calls because typically that's not a very good idea. But what we noticed about these, and I'm not going to be able to show you because it's kind of retroactive and these options have already expired, but the fact that there wasn't really any extrinsic value on the 7.5 strike calls. So essentially those were similar to share ownership with the advantage that, you can't lose any money below 750 since they're calls and they would just expire worthless. But with that said, there was some value on the 8 strike calls. And why is that with an instrument like UVXY? If we take a look at the 1-year history of UVXY, what is it prone to when volatility spikes? It's prone to these really, really big spikes. We can go like the 3-year chart and look at what happened during COVID. Like this is early 2020, and this thing had a enormous jump. So much so that a lot of the future spikes are a little bit muted, but you'll see them every now and then. But generally, this is a leveraged ETF. It's going to decay over time, but there's going to be these short-term price jumps, and a lot of them happen when RSI does hit that blue level. So what we did was we found ourselves in a position where RSI was kind of in the blue, and we found ourselves in a position where there was very little time until expiry, right? I believe we opened this position on Wednesday, and we were out of it before the end of the day on Wednesday. Where it was Wednesday, 23rd was Wednesday. So we saw that it was around 780-ish right here, and we entered into it, and we got a little bit of a spike, and before the end of the day, we took our profits. But even if we didn't take profits, the 7.5 8 strike called debit spread was a bullish position, and we'll look at this really quickly, right? We bought this for 26 cents, And if we didn't do anything at all, right, we took profit and made 120 bucks on it. But if we didn't do anything at all, UVXY finished at 775, and it would have been worth 0.25, right? 775 minus 7.5. So we only excuse me, these formulas are pasted so that nothing gets messed up week to week. But we would have only lost 20 bucks on it had we held. So the risk wasn't enormous. There was definitely a little bit of risk that if for some reason it fell back down to 750, you'd lose all of it. But the way that we look at it was we got a decent bit of value off the 8 strike call that we sell, right? Because when we buy a call credit or a call debit spread rather, we buy the 7.5 strike call, which had no extrinsic value, meaning it's a decent value for option buyers. And then we sell the 8 strike call on top of that to create the spread and give us a little bit of value back on the upside. And the great part about this, going back to the point that I was making before, is that since UVXY is prone to big spikes like this, there's typically a decent bit of call premium even in the short term. So the 8 strike call, I believe, had like 11 cents of premium on it. So you've got something right here where there's not very, you've got like 30-ish cents, 30, 35 cents of premium on the 7.5 strike call because there's a little extrinsic value. And then you get that 11 cents of premium off the 8 strike call that you sell, meaning you get a 26-cent debit that you pay overall. So even though UVXY was at like 782, this 26-cent debit meant that, here we go, Cash, what's going on? Welcome to the stream, even if you're only stopping by. Good to see you. Or good to hear from you. Good to hear from you. But the idea here is, even though this is an option buying play, we benefit from a cushion. So really the whole idea behind our option selling strategies is that they give us cushions there. Sometimes option buying strategies like this called debit spread that we opened on Wednesday that still give us that cushion while providing decent upside. If this thing had rallied up to 8 or above, we would have made about a 100% return on the trade. Now, that would require you holding overnight. It would have required you holding over Thanksgiving. Well, even though the market didn't trade, futures trade, something could have happened. There's a little bit of risk incorporated there. But with the short amount of time, with Thanksgiving being a holiday and last Friday being a stock market holiday, it was somewhat lower risk. And this is an opportunity that I think I'm going to look towards in the future. Because while the general trend is that this thing falls back down and the market was up about 1.5% last week, so there wasn't a lot of excitement with UVXY, it doesn't take a big move to get a big return with this type of a trade. And a 6% return, we could pull up the system calculator really quickly here. This 6-cent return that we got on a 26-cent debit, if I can learn how to type right here, 6-cent return on a 26-cent debit is a 23% return on our trade. And we got that in less than a day. We opened that one Wednesday morning, closed it, I think, Wednesday at like 1:45 p.m. before the FOMC minutes. So that's what we did there, and there was very low risk. Why did I think there was low risk? Because one, this thing doesn't really have a propensity to like limit down and have this huge dip. This was about the extent of what you would see with that kind of a dip, and it still didn't get down to where max loss would be at 750. And with the way UVXY works, there's always that little call credit available for the next week. So if you look at something like, we could look at December 2nd, it's not going to be quite the same because there's still 5 days till expiry, but I think you'll be able to see it a lot more clearly come Wednesday or Thursday of this week. But the idea here is that at 774, these things are trading at like, 40 cents a piece. So there's still 20-ish cents of extrinsic value on that. So we don't want to buy those yet. But once the extrinsic value on a slightly in-the-money call on UVXY gets close to zero, that's when you jump in and then you take the 8 strike to sell on top of that. And you might say, hey, well, what if UVXY spikes up to like 9 and I miss out on that? We don't worry about that because if UVXY just got above 8 in that situation, it's almost a 100% return. And if you get that in like a day and a half, that's a phenomenal value proposition. So that's a setup we're going to look towards in the future. And try to capitalize off of a little bit. But that was last week. There we go. Made it through the recap in a little over 20 minutes. We love those DraftKings trades. We love the UVXY trade that we just talked about. And really, I don't think strategically we made a mistake last week, and it resulted in a very nice modest profit of 1673. Yes, we did underperform the market by about 0.5%, but that's kind of the risk you run, underperformance in a green week when you're not using all of your account. Now, the flip side of that, of course, is what we look at the week before, where we made a very similar amount of money despite the fact that the market was red. The way that we have our account currently structured is for a very consistent 1-ish% a week. And again, why do we love 1% a week? Because a lot of people come from option buying backgrounds and say, hey, why are we looking at 1% a week? I see people out there getting, 50% a week. And look, that's just not sustainable. That's not smart. You're going to blow your account up, right? If we started this week and we look a week from today and we get a 1% return per week, you know what that gets us? It gets us a 68% return annually. And if we started with like a $15,000 balance, that gets you up to almost $250,000. And if the way these exponential gains or the compounding gains work are insane. If you get 2% a week, you go from having 200,000 at the end of year 5 to having 2.6 million at the end of year 5. So don't be shooting for these 20, 50, 100% returns on a weekly basis. 1% is right where we want to live. And if we underperform because the market's green, so be it. We're never going to get too mad at profit. We've got a question from Shibu T in the chat, and for some reason I don't think my chat widget's working on the screen, so I'll pull this on really quickly. But futures are opening red. Do we think we see a pullback this week? And I think that's a great discussion to have before we jump into our plan for the upcoming week. So let's pull up Thinkorswim again. We see the futures are down about 0.65%. That's decently red, especially from what we've seen lately. Does it mean that they're going to open red? Who knows, man? Futures, so they matter and they don't matter at the same time. But let's take a look at SPY and talk about some overall macro trends that we've seen in the market. And I'm going to take a sip of water real quick. It's not too bad. Excuse me. But we could see what's happened over the last 5 days, right? The market ran up about 1.5%. When we're looking at like a 5-day chart, this looks like a decently significant upwards move. But if we look in the scope of the last 180 days, that's not much. We've been in a very, very volatile market, and that volatility has definitely tapered off a little bit after we bottomed out mid-October and have risen back to about 400 on SPY since. RSI is back down to 50, which is about right where I like to have it. It was running a little bit hot towards the end of last week, right? It was up to about high 60s, 70ish, and that's the reason that we're running into next week only using 27% of our account because we were afraid of that kind of a pullback. And that's the general strategy we want to have, right? If we're a little bit afraid of a pullback and we're using RSI as our guide, we don't need to use all of our money. 5 days in the market is such a long time. And we're saying FOMC is this week. Is that true? Because I know we had it last. Last Wednesday, and they released notes at 2 p.m. last Wednesday. I have not taken a look at the economic calendar yet for this upcoming week, so I don't know if that's 100% true. But if that is true, definitely something to keep an eye on. There's a lot of data-driven events, especially revolving around inflation that we've seen. That the market particularly has reacted to. But with that said, at the end of last week, what we were looking at as we started to plateau and peak right after Thanksgiving, around the 70-ish RSI level, which we never really want to be buyers around that level. But with that said, we've fallen back a little bit via futures. So once the market opens tomorrow, I'm comfortable maybe adding a position or two and getting back into that 40-ish percent range. But far, far away, we do not want to be up near 100 yet, right? It'd be great to, have ourselves in position to have like a $4,000 week, but, it's kind of like the tortoise and the hare. There's no such thing as a shortcut in the market. Targeting that 1% return per week is the way that we want to approach this, right? We do love the pullbacks, admittedly. It's definitely a little bit of a sadistic approach, but we love the pullbacks because it pumps up premiums, lets us sell some nice premiums. And for example, we got that pullback on DraftKings last week, and it allowed us to make even more off DraftKings than we would have if it had a relatively sterile week. But so that's the idea right now. We think SPX is going to come back a little bit, and just because we've dropped 0.2% on futures, that's not like, okay, we're running through the streets, we're having a parade, we got the pullback we want. The pullbacks in this market have been quick and they have been violent, right? This pullback that we're seeing just on futures is going from 402 to 399, which is like $2 on the SPY ETF. I mean, we've had individual candles where we've gone from 370 to 359. So we've had individual candles on a 4 hour basis that are like 3x the magnitude of this move right now. Right, we've got some pretty big red candles, and the market does a very good job a lot of the times of just lulling you to sleep, especially in a market like we've seen in 2022, which has really been one of the more difficult markets historically to trade in. It can have a it can do a very good job of lulling you to sleep and thinking, okay, we've bottomed out at 350, we're good to go, nothing's gonna go wrong. The coast is clear. Let's start getting into larger positions and catch a little bit of a rally. But I would definitely caution you against that, right? We want to get aggressive when the market is red, not when the market is green. Because look, if we run 4 more weeks in a row of the market going up like 1.5% and we underperform slightly every time, but we get our 1% every single time, so be it. What we want to avoid is the mistake we made at the beginning of the year, where if the market has a huge drop, we're far outpacing that drop, right? When the market dropped 5% and we lost 14%, which is due to something that we are never going to do again from a margin perspective. Live and you learn. But that's the idea, right? We've adjusted our strategy to try to succeed in the current market. Play the hand that we've been dealt, so to speak. And that involves having these smaller position sizes headed into a week. And not to get frustrated if there's a green week and you miss out on some big rip in the market. Just so long as you position yourself to make money, period, and get to that 1% mark that we'd like to see if the market is green, that's pretty much all we can ask for on a week to week basis. What we really want to avoid is this big red candle knocking out the progress that we've made over the last 3 weeks, where we've taken home about $7,000 of profit. But that's the point I'm trying to make here from a macro perspective with the S&P 500 is the second you think like, oh, the volatility is over in the market, that's probably when it's about to come back, right? Market sentiment is a very funny thing. If you were on social media reading posts on different forums, if you're going on any like subreddits reading stuff when the market was bottoming out at mid-October when it was at 350, I mean, you'd have people who were talking with so much conviction and certainty saying, okay, well, we're going to drop down to 300, all the way down here, and then bounce. But at the end of the day, no one knows what's going to happen in the market. The closest thing to a sure thing in the market is that it goes up in the long run. So that's what we play. But with that said, RSI is definitely a very important consideration. It was starting to run a little bit hot on a 180-day basis. And we just do not want to put ourselves in a position where a big red drop like we've seen several times in 2022 so far, puts us down and out a little bit. So that's where we're at. And if we never get that, we never get that, so be it. But even the slightest of red weeks, like when we drop 0.6% on SPY, we're still hitting our target. That's the benefit of the strategy that we're running. So with the strategy we're running, let's finally get into talking about what we've got for the upcoming week and talk about our plan, put together a little bit of a wish list, maybe talk through some earnings, and then maybe run through a couple strategies outside of our typical HT wheel, like some of the sympathy strategies, sympathy straddles that we like to run in anticipation of earnings. So let's get into it top to bottom. It's going to be a very quick recap right here, right? We've got approximately 5 different positions as we head into the week. The first of which is Affirm, a 12.5 strike put. We were in 13 last week, made $420. Nice. We can roll the strike down, we could roll the strike out, and put ourselves in a position to make an equal amount of money at a lower strike. Mission accomplished, right? MSOS. Last week we were in, where is MSOS? We were in 11 strike puts for 30 cents, $300 of profit. This week we're at an even lower strike, even more profit. Mission accomplished. Now with MSOS, the volatility on that is a little bit, above where it typically sits. Premiums are definitely inflated. I think they're about, off the top of my head, like twice as large as they typically are, but I think that is due to some sort of legislation coming through the House regarding legalization of marijuana, which that's exposed to. So instead of, getting a little bit greedy here, looking at MSOS option chain, instead of getting greedy here and taking like the 12 strike or the 11.5 strike to go for 2x the return, we just walked it down to the 10.5 strike. Give yourself a much bigger cushion, right? Give yourself a cushion down to about 10-10-ish, 10-15. Draw the line right there. That's our break even for the week. Can we see it slide down there? Absolutely. That's why this is a half size position and we could average further in. But what I do love about this is while this is a little bit risky because there's some stuff going on in the house, one, we've got that half size position, and two, MSOS is a cannabis ETF, meaning it's a culmination of a lot of different cannabis stocks. So where you might see something like a Tilray, TLRY, have these big individual spikes and dips, or maybe like CGC is one where you see these big spikes and dips. MSOS is a culmination of all of these, so you see a much flatter general trend. So the idea here is that while the premium is elevated, we're a little bit less at risk of having something like this fall off the face of the earth. But while we're on the subject, I do want to take a look at the Tilray. Let's see. Option premium. And what's interesting here is it's nowhere near as high as MSOS. And typically when you see higher put premium, one thing could potentially happen. They could be paying a dividend and the stock is going to be going down. That doesn't appear to be the case because if we look dead at the money, the premiums are almost identical. When a dividend is going to be coming up and the stock price is going to decrease, you'll see a lot more put premium than call premium because that stock price decrease based off the dividend is going to be priced into the options. But this is a quick, easy way to check something like that. And this is where it sits, and I'm pretty satisfied with that one for the upcoming week. It's been like I'm not even gonna say because I don't want to jinx it, but this one has been very good to us this year. So far, this one's been a little bit of a pain in the ass, but look, we liked it at 6, we liked it at 5.5. It did break below that. It dropped a bit on some news that they were extending the loan forgiveness, student loan forgiveness, things like that. I'm definitely a little bit surprised at how easily it gave away 5, because this has been some pretty strongly established support. However, the earnings that the company has had historically have been pretty decent, right? We see earnings reported here, ripped off of those. Earnings reported here, again, ripped off of those. Earnings reported here. That's another big green candle before selling off, but the numbers they've reported are strong. And that 5 level, I mean, from a chart perspective, looks phenomenal, which is why I was fine to have a bullish position on it last week. Obviously, that did not quite hold, but with it being below that 5 level, looking at this over the last 180 days, looking at the RSI, this is about as good of an entry point as you'll ever have on this thing. Or I guess as good of an entry point as you could have had on this thing over the last 180 days. We were able to sell a 4.5 strike put for 12 cents of premium, meaning we've got a 438 break-even price. So as long as we stay above this number right here for the coming week, we are going to make money. So that's a decent return right there. And I think if we look, there you go, just a hair under a 3% return on capital risked. So very, very nice number in our pursuit of getting a 1% ROR on the week. DraftKings 14.5 strike put. We've been in this thing forever, man. We actually, what's today? Today's 11/27. We started trading DraftKings on 11/26/2021. So we have finally hit the 1 year mark of our DraftKings trade here. And if we walk down to see where we are, we're actually profitable on DraftKings so far. And I don't even have, a couple of the trades from last weekend. But I think we're looking at close to $2,000 of profit on DraftKings, despite the fact that over the last 2 years when we've traded this thing, it's dropped almost 60% on us. And this is like, I love this tab in my spreadsheet right here, because this is like the quintessential example of using the HT wheel strategy, scaling in, scaling out, taking assignments, selling calls, increasing, decreasing position size, and just sticking with something, slowly decreasing your break-even price until ultimately getting where we want to get in the trade. But yeah, I'm going to keep playing that one because of that. And then last but not least, to round out the account, is SPXU 15 strike puts. What is this? It's an inverse S&P 500 ETF, meaning that if the market tanks, this thing's going to go up and we're going to hit max profit. We could potentially recoup about $245 on it if it does go back up to 15. But again, very small position size. It's about a half position size. So we'll treat this the same way that we treat our typical trades. If the market starts to go up, we'll average into the hedge. And if the market goes, if the market goes down and this goes up, we average into the hedge. If the market goes down and this goes up, then we don't need to do anything, and our hedge gives us $250. So there you go. We've got four bullish positions. We've got one hedge, and I think that's a decently built delta neutral portfolio. It's only taking up about 27% of the amount of cash that we have in our portfolio. We're a little bit under the target return that we would like to have of 1% in a week, which we have basically hit the last 2 weeks, 1.04 and 0.96. And I think, did we hit it the week before? We were 2% the week before that. So definitely on a roll from a target return perspective. But we want to add a few more trades. And the thing about this is, I've already said it multiple times on this stream, but can't emphasize it enough. 5 days in the market is a very, very long time. So there's plenty of time for us to go from a portfolio that looks like this to something that looks like this, or from previous weeks where we look a little bit longer from a position perspective. But like, 2 weeks ago, we added $2,100 from new trades. Last week, 2 weeks ago, we added $1,300 from new trades. Last week, we added about $1,000 from new trades. So the idea is that if we have this, we scale into new trades that maybe get us between $500 or $1,000. That gets us near $2,000 in net profit, and that gets us right to the number that we want. So now the $1,000,000 question is, okay, if the market starts to move back, or even if the market trades flat and RSI gets back down to the 50-ish level on the S&P 500, what are those positions that we want to target? So let's jump into Thinkorswim, and let's start to get a little bit of an idea of what we would like to do from that perspective. So we're going to go to our scan, and let's just, very basic high ROR puts without earnings, and let's see what it gives us. All right, and as you can see, there are some very high ROR puts that do not have earnings. Zim is at the top of the list. That one's pretty interesting. I know they pay a dividend, so this may be an example. Perfect. We talked a second ago about how MSOS, we wanted to make sure a stock wasn't paying a dividend by looking at the premium of the call versus the put. Let's take a look at Zim. Closed Friday at 25.67. So we could, call 25.5 at the money, so to speak. And the puts are offering $2.55-ish. And the calls are offering 15 cents. Why is that? That's a massive discrepancy between the price of the calls and the price of the puts. And the answer, of course, is because they're going to be paying a dividend. So if we look and see where the premiums are a little bit more equal, it's down at 24. Nice pronunciation there. Yeah, they even out a little bit at 24. So I'd imagine they're paying a dividend in the $1.50-ish range. But could definitely also be wrong there. I'm not entirely sure how to tell from Thinkorswim, to be honest with you. Let's go down here, look at Zim. They're paying a $3 dividend. $3 dividend on 11/28. So a $3 dividend gets it down to like 22.67, and that would put you at like a 3.9% return at the money if you wanted to sell these. However, this stock's been very volatile. It was on my watch list because it has historically had decent option premium. Their earnings were nice, but this is a lot more reliant on a different macro trend, and that's the prices in shipping containers, because they're like a shipping company. I think an Israeli-based shipping company. Could be wrong on the nationality there, but point being, this was caused maybe not so much by good, consistent, repeatable company performance, but rather by the increase in price globally of what they're selling, which is shipping containers. So with that said, I don't expect it to stay this high. I definitely could see a retracement back down to this, sub 20 level. If it does get back down below 20, I think that makes this company interesting. But up here, not something I think I want to touch yet. Carvana is one that we've historically played, and of course this thing's popping up. Let's take a look at it. I didn't go in initially because I didn't really like where it was sitting. We go to the 5-day chart. Look, this thing has been to the moon and back, going to almost $400 a share, now back below 10 in the span of a year, basically. But this thing was at 670 before it bounced and ran and ran. This stock is kind of garbage. It's one of those that we played just because the premium was really nice, and one of those things where it's like, yeah, it's probably going to go down, but will it go down this much? Probably not. And we made some cash off that. However, we want to know when to take our chips off the table and leave, right? If you stay in the casino all day, you're probably not going to be a winner. Not to say that this is gambling, so to speak, but it's definitely a little bit riskier than the typical type of trade that we would like to approach. So if we do see it run back down, right, and we can maybe use the 20-day to gauge, and if it runs back down and RSI gets back down to these levels, maybe we'll think about going in because they've got some starting to establish a little bit of support in the 650 range. But if you look at 650, look, it's 2.77% ROR, which objectively is a nice number, but for the amount of risk you're taking on here, you ideally would like a much, much larger number than like 15 to 20 cents at that 6.5 strike. Case in point, I think last week we got 25 cents, which is maybe not significantly larger, but a little bit larger. We looked 2 weeks ago at Carvana. We got 23 cents on it. Maybe I'm just being a little bit stingy, but I definitely know what the premium on these things can do when the stock gets dropping. And since it's on the back end of a rebound, we think the stock is garbage. Let's just let it come back to us, right? There's no need to make trades that we're not 100% in love with. AMC, I'm not a huge. I really like going after that one when the market is in turmoil because it could act a little bit independently of the market. A lot of the times it'll drop big if the market drops big, but that pumps up premiums. It'll rebound a little bit faster. You work with that. None of the other stocks up here are terribly interesting to me. Upstart is basically the same thing as a firm, so we already have a little bit of risk from a diversity perspective. I don't really want to put more of my eggs in that basket. Unity is like, I know we used to play this thing in the mid 30s, but the move that it recently had, those of you who have watched it know exactly what I'm talking about. This makes it pretty hard to trust, right? It ran from 30 down to like 21, and then it announced earnings, went to 18.29 after hours after it announced those earnings. And then within 1, 2, 3, 4 days, it had over doubled in price. And for a company of this size, that's a very, very significant move. So long as it stays up in this 30-ish range, I am very, very suspicious of Unity. We've got this support that we previously had charted a little bit right around 30. If it falls back to 30, we'll start jumping back in the high 20s. No problem doing that. But for now, this seems a little bit elevated to me, and RSI demonstrates that slightly with it sitting at 62. But again, one of those things that I tend to think is an unnecessary risk for the coming week. But with that said, look, we know when we run this high ROR puts with earnings scan, we get a lot of results. We've got 577 results. And something like Unity that just popped up is very overbought, meaning that would take it off of our list. So let's make our scan a little bit more focused and only target stocks that are oversold, meaning, theoretically from a TA perspective, an RSI-based technical analysis perspective, find some things that suggest a better entry. So we're going to intersect this with the, where is it? Oversold stock scanner. We click scan and we get from 577 results to now just 6 results. And a lot of these are going to be some familiar stocks, right? 3 of them are volatility-based instruments that are just not a very good idea to go long on. Those are UVXY, VXX, and VIXY. I would not recommend any of those. There are 3 more with Mara, which we know is Marathon. It's a crypto-based stock. And then the last one is SDOW, which I don't know what that is. But let's take a quick look at Mara. We could play devil's advocate here for a little bit. I don't love to have a ton of exposure to crypto because I just, personally, I don't think it's the best idea in the world. But like if you look at this on a 180-day perspective, there's previously been support at this 6-ish level. Yes, we've seen it fall to 5.2. We go to the 180-day, we're still here. We look at RSI. I mean, it was in the gutter last week. Still down around 29, meaning it's hanging out in the very oversold area. And it popped up on our scanner, so we know that there's some pretty high premiums on it, right? We only like to target about 1% per week, and you can get 1% down at 4.5 a share. 4.5 a share, meaning as long as it stays above here for the next 5 days, you're going to make money on it. But then the question that we want to ask ourselves is something like Mara, with what's going on with FTX and all these other crypto exchanges, is a company that's so heavily dependent upon crypto worth that kind of a risk? And for a 1% ROR, I don't think it's worth that kind of a risk. Now, if you wanted to bite off a little bit bigger of a chunk and go for like a 5% ROR position, This is an example of where I think that, stepping it up to 6 and going for a 30-cent credit might be a little bit better of an idea than taking the more conservative 4.5 strike put. Because the reward's a little bit bigger, right? And if the thing drops, the thing drops. And you're going to be a lot more upset if it drops and you were in on it for a 1% gain, as opposed to if it drops and you had a 5.45% potential gain. I wouldn't necessarily go in the money to 6.5 or 7. While that definitely does increase the potential rewards, we always want to protect our downside risk with that initial position. But look, if you sell the 6 strike put for 31 cents a premium, that's a 5.69 break even price, meaning you're going to make money so long as the stock stays above here. And look, we've also seen how rapidly the stock can drop. I mean, just between the 18th, the 21st, 22nd, 23rd, just the last 5 days, this thing's gone from like 8.40 to 6.1, but it's starting to flatten out a little bit. But personally, I don't like crypto related stocks. It's not for me, but I will always tell you we don't have to agree on different stocks. We don't have to agree on different trends. I do think the one thing that it is important that we agree on is how we trade these certain theses that we have. And I think option selling is a phenomenal way to do it. So if you are bullish on crypto, this is probably a pretty good place to look. We've got Jules saying that Fidelity is advertising that they will be trading crypto. So potentially, and hey, how's it going, Jules? Welcome to the stream. Hope you're having a great night. But yeah, potentially adding a little bit more legitimacy to the whole crypto area, but just still not something that I'm terribly comfortable with. And then the other stock that we've seen come up on here is SDOW. SDOW. It's an Ultra Pro Short Dow ETF. So this is just another thing similar to UVXY. It shorts the Dow. It's similar to SPXU, which we already have a position in. So not necessarily one that we would like to get in on. And as you can see, there really was only one. It was crypto related. We don't have any general, non-crypto, non-inverse companies on this list. That goes to show you there just generally aren't a lot of phenomenal entry points in the market right now, and that's okay. We don't need to try to make something happen, right? Trying to trade just to trade often leads to you getting losses that you very quickly regret. There's never been a time where I wish that I had less buying power in my account. It's always these times where, I think experience is one of the best teachers for something like this. There's always times I can look back to in the past where I'm like, oh my gosh, I'm close to a margin call. I wish I had more buying power. It's okay if you have a boring week. Last week was a boring week for us, and we still made, where is it? $1,700. Did we underperform slightly? Yes, but 2 weeks ago was also a little bit of a boring week, and we outperformed by 1.6%. So boring weeks where we make money are the name of the game because they lead to compound growth, and that is how we're going to outperform the market on a long-term basis, which is our goal that we have accomplished since we started publicly tracking our trades since July of 2020, where we've outperformed NASDAQ by about 130 and outperformed the S&P 500 by 110%. So even though there's some slight underperformance, maybe some boring weeks recently, we're going to stick to the strategy because we have some conviction that the long-term strategy works. And our goal right now is just to get this number positive on the year. And what's been a historically difficult year where the S&P 500 has recovered a bit, but is still down 15%, and NASDAQ is down almost 30%. If we could walk away profitable, I think we've executed phenomenally, especially considering we made some very, very big mistakes at the beginning of the year. We dug ourselves a 40K hole at the beginning of the year. The market continued to drop after that, and we're still in position to potentially make profit on the year. So things went about as bad as they possibly could to start the year off, and we can still make money, and I think that's about as good of a testament as we can have to this strategy. Andrew in the YouTube chat, appreciate the comment. Thanks for joining us, even if you got to run. The replays are always posted to YouTube. But let's keep going, right? We don't really have too much of a wish list. Yes, it sucks that there aren't a lot of like home run, okay, easy layups. This is a phenomenal place to enter. We could look to our watch list, look at something like Palantir, which treated us well last week at the 7 strike. Yes, we've got the 1.3% there, but look, this thing is pretty volatile as well. We see a 3-day range where it's traded in like, I guess a 3-day time span where it's traded in a roughly 80% range, 80-cent range. It's getting to that hour of the stream where I just, start messing up my sentences entirely. But that's a lot of volatility. Is getting only 9 cents a premium on a 7 strike put worth it? To me, I don't think the answer to that is yes. So one of those that you keep on the watch list. If it falls back down to 7, that's when you hit it. And if it doesn't fall back down to 7, it means the market probably had a pretty good week. And we're going to take home this. So, big picture, always have some sort of bullish positions in your account. Because if the market goes down, great, we can add more. But if the market goes up and you have nothing because you're just waiting for the market to come back to you, that is going to be a week that you very, very much so regret. We at least need to make something if the market goes up, because our general thesis is that long term, over time, the market goes up. So we want a portfolio that largely skews bearish or bullish majority of the time. Now, there's some times where we lean a little bit more heavily on some bearish type trades like credit spreads, but that's only when RSI gets very, very overheated. But from that bearish perspective, let's run a quick scan, right? We've got oversold stocks. Let's take a look at some HT overbought stocks as well. So these would potentially be trades that we play bearishly, meaning coming back down. And ROST, do I know what that is? Absolutely not. But let's take a look at it, because it's one stock that has popped up on this scan. It's Ross Stores, department stores. Interesting. And if we look at a 180-day basis, they just had earnings. Earnings allegedly went great. They went from 100 up to 115. And RSI is running very, very hot on a 180-day basis, meaning it's probably about time for this thing to start coming back down. Now, implied volatility is almost at a 180-day low. However, it came up on this scan, so that at least means there's some sort of premium. We can maybe back up to the 1 year. Still not terribly high on a 1 year basis, but if we look here, we've got some precedent for this thing potentially falling back down at these levels. Let's back up a little bit further to look at the 3 year and extend this line to the left. It looks like maybe 125 might be a little bit better of a level. Maybe 120-ish looks a little bit better, because that's kind of where it peaked here and where it peaked here. Let's take a look at a short trade for next week using a 120 strike. So the way that would look is it would be a credit spread where we sell the 120 strike, which has about 40 cents of premium, nothing really to write home about. Let's go vertical here, and we go 120, and we can maybe go 125. And that looks horrible because there's no volume on it right now. But if we look at maybe 121, or we could maybe do, let's just look at 116, 120, dead at the money. 147, you've got, okay, about 60% return on that one you're looking at. But we really like that 120 level a little bit better. If we look at 120, 121, that offers 17%. It's, not a huge number, but it's outside of the market maker move by, 2 full market maker moves, right? It's $4 out of the money, and the market maker moves $1.81. Market's running hot. This thing's absolutely running hot, but we, like that 120 range a little bit better. And the other thing that we could maybe talk about here, and I think this is a great time to talk about it, because we did it with Unity a couple weeks ago, and it worked very well, and we didn't have a stream where we were able to discuss it. But it's the idea of playing the wheel in the other direction. So if a stock moves against you, as what happened with Unity, we had this 36, 38, or I guess we had, let's sum this whole thing up. We had this 32.5, 35 strike call credit spread. And as we saw a second ago when we pulled up that Unity chart, it went on an insane run. We were trying to look at RSI as a technical indicator. We're trying to play it back down a little bit. Both I think were smart ideas. But look, sometimes the market can remain a little bit irrational, a little bit longer than you could remain solvent, but we followed our typical strategy, right? We close out, we slightly increase the position, we roll it up, and then it kept running. So what I don't want to do is increase these credit spreads further. So what we did was we actually closed the 38 strike call, right? Because you'll remember that a credit spread, it takes 2 legs. The first is the short leg that you sell, which on the 36-38 would be the 36 strike call. And then the leg that you buy behind it to make yourself, to put yourself in a defined risk trade. Now that does reduce the overall credit received, but being in a defined risk trade makes the benefit far worth it. But you'll remember when it runs against you, yes, you're looking at a loss on the spread, but remember that one part, that 38 strike call that you bought is making money. So what you can do is if a stock is running really, really hot, you could actually close that out. And we did so for a $252 profit. We closed it out for 84 cents. And then before the end of the day, we sold it, or we bought it back for 56 cents, which is like a 28-ish cents benefit. And then it ran up again. So guess what? We dumped it again for another $150 of profit. And then before the end of the day, we bought it back again to cover the spread for 66 cents. So in that little maneuver that we had right there, we made 402 bucks. And from that point on, we let the spread run its course. It fell back down. And even though we lost 452 on the initial spread, and even though the second spread that we opened ran against us, in aggregate, these trades made us $52. So even though it ran against us horribly, I think it ran 20% against us, we still made money on a bearish trade. And I think that is a good lesson to have for potentially managing something like this. And the other thing that you can do, which is what we did with CLF that same week, is we love the bullish HT wheel type trade where we buy shares and like sell covered calls, or we sell cash secured puts, which are effectively the same position. What you can do if you're bearish on a stock is do the opposite of a covered call, which is a covered put. So what do I mean by this, right? When you have a covered call, for example, you have 100 shares, you sell a strike, and if it goes above that strike, your calls are assigned, meaning your account loses the 100 shares that you own. The opposite of this would be selling short 100 shares, which is what we did with CLF. And then instead of selling a covered call, we would sell a covered put, meaning it's covered by our short share position. What does that mean? If we sell a put that's in the money, what happens? We're assigned those shares. So we'd be assigned 500 shares in this example for CLF. However, we have that short position of 500 shares. So if we're short 500 shares and 500 shares get assigned to us via the put, our net position is zero, and it's been settled the same way that assignment on a covered call would act. But that's what we did with CLF, and it made us $165. So I was a little bit uneasy because I wanted to test the waters on it a bit. But I think it's a great way to play a stock that's stocked back down that typically shouldn't be that high. Now, the downside here is that theoretically, when we're selling cash secured puts, a stock can only go down 100%. It can't go worse than zero. If you're short on a stock, it could go up more than 100%. So there's definitely some upside risk there. You want to be careful about what kind of stocks you use for this. I used CLF, which is a commodity. It's traded within a certain range and it worked very, very well. I would not do this on something like an AMC, where you potentially could see a stock just absolutely shoot through the moon and you get crushed. But it is something when the market runs a little bit hot that I might look to do, add some bearish trades via a reverse HT wheel. And why do we like that? It gives us that bearish trade to play the market back down, and it also gives us a cushion to the upside in case we're a little bit wrong. And we've got several ways we can manage it from there. But with that said, look, Ross, it's tough to say, right? If we look at the single legs, there really wasn't any volume at all at 125, so it's tough to say what those would be going for. But these look about worthless, trading between 5 and 20 cents. So we can maybe look at a 120, 123 spread. And that offers 32 cents a premium, right? And yes, the max loss here is 2,680. You're getting up slightly above a 10% return on the position. However, of course, you risk a 100% loss. But yes, the max loss is 2680. However, it's one of those things where, is this thing going to get to 123 in a week? It doesn't have earnings. Nothing's really going on. Is it going to get all the way up here in a week? Probably not. But I'm a fan of that because from an RSI perspective, it's bound to cool off. There's a decent bit of premium. We could capitalize on it. I don't hate the idea of potentially trying that out. So let's talk about, let's throw this on here. ROST, is it Rost? Yeah, I don't know why it's Rost T. ROSS seems like a pretty straightforward ticker for that one. But 12-2, let's make sure those are 12-2. Yeah, 12-2, 120, 123 strike calls. And yes, the risk reward on those is going to be a little bit skewed, but it's going to give us a 10% return potentially at max profit. And then also from there, we've got a very, very large cushion. I think mathematically it works very nicely. And one of those where, look, if we sell this thing for 32 cents, we don't need to wait all 5 days for 32 cents. The way RSI typically works, and we could potentially look at Ross's chart, when it peaks like this, it typically comes back down, or at the very least flattens out. But in the instances we've seen it happen here, most recently it flattened out a bit. But when it peaks, it comes back down. If it does come back down, easy money, we just close early. And that's all you got to do. Just close early. You don't have to make all $320 of profit, because closing early will lock in maybe $150 or $200 of profit. and you say, oh, I'm going to leave $100 on the table, but is it worth holding out for $100 when the flip side, the risk is that something crazy happens and you lose $2,700? The answer is no. A great way to evaluate should I hold on to this trade is if you had no money in the market right now, is that a trade that you would enter into? And that's probably the simplest way that you could evaluate the positions that you currently have in your portfolio. But I like that as a bearish trade. Look, one of those things, unfortunately, I'd love to have this laundry list of really bullish options that we could add and add and add and add. But I think we have a decent starting point. If these run below their break-even prices, which would take decently large moves for that to happen, we double down because we're at half-size positions on everything. And if these drop, 7.5%, if MOS goes down 16%, if SoFi and DraftKings drop about 5%, I guarantee you that this scanner that we have right here, where we're looking for oversold stocks, if I could pull that up as I say it, it's going to look a lot longer than this list, and that's what we'll leverage going forward. But a good amount of cash. I think next week is going to be one of those play it by ear weeks where, stay tuned to the Discord. We're going to have a lot of activity Monday, Tuesday, Wednesday, trying to build that account up to at least a 50% size. So we're trying to double the amount of positions we have, but we want to be smart about it, right? We don't want to just throw all of our cash in at market open on Monday and, hope for the best. Because there's a dumb way to do it, which is that, and then there's a smart way to do it, which is understanding that 5, 4, even late 3 days till expiry, there's still some decent premium on things. Wait and pick your position strategically, because again, if we don't get the drop that we're bracing and preparing for, we're gonna walk away with 4 figures of profit, and there's nothing wrong with that. But I think that's about all we've got, right? Very short list. Definitely stay tuned to the Discord. We're gonna have some call outs going. But appreciate everyone who's tuned in tonight. The replay will be on YouTube if you tuned in late. Stay posted to the Discord, hourglass-trader.com. You can join that for free, and we also have premium channels available. But until next time, let me go full screen right here for you. Until next time, this has been Hourglass Trader, where as time passes, we make money. Hopefully, we'll see you guys again same time next week with a little bit more money in our account than we currently have right now. Appreciate all you guys who spent your Sunday night with me, and hopefully this will look a little bit longer next week. I say this, I know I'm not screen sharing anymore, but hopefully the list of positions that we share will look a little bit longer, profit will look a little bit bigger, and then we just manage things the way that we've laid out. But appreciate everyone who's tuned in week after week, and we'll see you guys again next week. Thanks.